There we go. Should be live here. We'll, wait a few minutes as people start to jump on here. But again, like I mentioned, we'll blast this out to anybody that missed it live. Over YouTube, email, within the DealMachine app, all of that. But what was your topic in Dallas on?
It was real estate.
Just broadly.
Well, yeah, it was real estate tax. I talked about. I actually got into a little bit about the patterns in the tax law and how to follow the patterns and coming up with a system to follow the patterns. And then we talked, I gave these were syndicators. I gave them all a hard time for not doing cost segregations.
Which fair.
I pretty much called them all out, and because a lot of them don't, and they're being cheap with their investors' money, and the difference financially is huge. The return on investment, the difference in return on investment is, you double your return on investment if you do a cost seg, basically.
Wow. Especially the scale that they're working at, probably. So,
well, no, just think about it. If you put $100,000 in a deal and you get 40% back from the government, you've really only put $60,000 into the deal. So look at what that does to your ROI.
Yeah, fair.
Just skyrockets your ROI.
Yeah. And I'm excited to dig into all this stuff with you today too. I know for everybody jumping on, we'll be covering kind of, current events type stuff. So I love how you talking about patterns within, tax reform, and then best practices around things like what you just talked about there of like, hey, how do you, save the most, with your deal there, with, each individual real estate deal. I know to kind of start to kick things off here, Tom, too, wanted to say hi to everybody. I know we're live on YouTube, Facebook, a couple other places, so we'll have people start to trickle in here. Again, I'm at camp with DealMachine, really run our partner program here. Love to do stuff like this with our partners. Feel free to jump in and say hi on the chat. Anthony, hello too. Tell us where everybody's calling in from. I know, Tom, you're in Phoenix today, I assume.
I am in Phoenix today. There you
go. Yeah, and I'm back home in St. Louis now, but great seeing you last week as well. Really enjoyed that in person. But I am excited to have you on as a kind of a returning guest. I know we had you on for our Thought Leader Spotlight series, the interview we did a few months back, and we're doing a kind of a special Lunch and Learn edition here, so that way people feel free, as you're watching this, to jump in and ask questions. And Tom's been we're really thankful for his time today. So if we have any live Q&A, that's always great. If not, I've got plenty of questions on my end for you too, Tom. So we'll have a fun time either way. But excited to have people on. But you got people from Columbus, Atlanta. That's great. Tom, to kind of begin with too, can you maybe talk a little bit about your background? I know to tee you up for everybody. I know you're a best-selling author within the Rich Dad, Poor Dad Advisor series as well. CPA for Robert Kiyosaki, and a global speaker with a couple of popular podcasts yourself, and a contributor to, everything from like Entrepreneur to Forbes, the Wall Street Journal, all over the place. And outside of that, you're a real estate investor too. So you've got the tax knowledge, you do it yourself. You've got a variety of things that we can have the audience ask about, but maybe let's start with your personal journey and to give people a little more context as well.
Yeah, probably one of the most important things to know is I grew up in Salt Lake City, Utah. So I was when I was 19, I spent 2 years in Paris, France, learning how to be rejected in French for the Mormon Church. So anybody who's done a real estate deal knows all about rejection, and we learned it. We learned it fast and furious, getting rejected day in, day out there in Paris when I was on my mission there. I spent a couple of years at the University of Utah, did my undergraduate there in accounting, and my graduate work at the University of Texas to get my master's of tax. I spent 7 years with Ernst & Young, one of the largest CPA firms in the world, including 3 years in their national tax office in Washington, D.C. I spent 14 years as an adjunct professor in the Master's of Tax program at Arizona State University. I spent 4 years as an in-house financial tax advisor, for a Fortune 1000 company, and 25 years building, buying, selling CPA firms, and then it's been about 15 years I've been traveling with Robert Kiyosaki around the world, talking about really doing financial education. And he always likes to take me because the tax law backs up what he talks about, because how you earn your money, which is really the fundamentals behind Rich Dad, Poor Dad, how you earn the money makes such a big difference on how much tax you pay. So real estate investors find, and we'll talk about that today, I'm sure, that if you make your money in real estate, you tend to pay a lot less tax than if you make your money at a job. So, or if you make your money, or then if you make your money as a lawyer, accountant, a doctor. So it's really the investors who do what the government wants done that get the benefits. And these days, I spend my time teaching other CPAs. So we spend a lot of time with our network of members, CPA firm members around the country, and teaching them how to think a little differently about the tax law.
Yeah. Excited to dig into all of that. And I know for the people joining us today, I know we're really going to cover kind of coming tax changes, just the current state of tax reform, and then get really actionable on how to eliminate income taxes from real estate deals, and give specific strategies there that you just alluded to that, Rich Dad, Poor Dad's obviously known well for. But yeah, I was curious with your background too. How was how was the experience of working at a, E&Y at a, these huge, top 4, firms versus going out on your own? Like, curious of your perspective there.
Well, I especially my time in the national office, I saw that as postgraduate education is what it was. I mean, the amount that you learn about the depth of your knowledge and the breadth of your knowledge that comes from working in Big Four is really significant. So, it really gave me a very sound basis on which to build CPA firms. So, I have all the sound technical background built, and do that. And on top of that, I spent 3 years building training programs and teaching other CPAs while I was there in their national office. So, it was a great foundation, absolutely terrific foundation. Back then, they actually served entrepreneurs and real estate investors. Nowadays, they tend not so much. They tend to serve the big guys only. So I had an opportunity to do a lot of real estate and a lot of small business when I was at Ernst & Young, which you would not get that opportunity these days.
Sure. Yeah. And I love hearing about that. And I know that's part of your story of what makes you so credible to speak on all of this today as well. But, I saw somebody jump in on Facebook asking about, tax breaks for those who make their money in real estate versus W-2. We'll definitely go over, the advantages of real estate investing when it comes to taxes today. To kind of start with, Tom, I'd love to hear your initial thoughts on, I know we talked a little bit around the current proposal that's out there. You sent me that Wall Street Journal article. Can you maybe give our audience the lay of the land of what's going on today, what's changing? I know you've really have your pulse on that and do a significant amount of reading there, if that's okay.
Well, let's back up and just a little bit of context for how the tax law works. You have to start by remembering that the tax law is fundamentally a series of incentives. Okay, so and those incentives change from time to time, and so this new law is a change in the incentives. That's really what it is. But most of the tax law is incentives. I mean, it would take literally 30 pages. You'd have a 30-page tax law if all you were going to do is raise revenue, but it's all the incentives in there. And historically, the incentives have been very heavy towards those who create jobs. All right. So there are a lot of business incentives, a lot of incentives for the Amazons of the world, Walmarts of the world, who create lots and lots of jobs, which is why they don't pay a lot of tax. There's a lot of incentives for innovation. Research and development tax credits, for example, and deductions. There has historically been huge tax benefits for oil and gas in the U.S. tax law. And by the way, those aren't going away. So there was some discussion that those would go away, but they are not going away. I think they're here to stay just because it's too big of a deal for our defense as well as our economy to have that oil and gas drilling, even though the goal is, renewable energy. Then there's tax benefits for agriculture. There's tax benefits for renewable energy. There's tax benefits for housing, right? I mean, think about this. When you go buy a house, you get, one of the things you're looking at is what's my tax deduction for the interest expense when I bought that house. Well, if you go rent an apartment, you don't get that interest expense deduction. So that's an incentive for people to buy a house. Now, here's the fundamental thought process. Think about this. We are all partners with the government, like it or not. And if you, next time you get your paycheck and you look at it, you go, who's this WH? That would be the withholding. And who's this FICA person? You know, that's Social Security. We're partners with the government, and we get to choose whether we're active partners or silent partners. And employees tend to be silent partners. Okay, they just pay their tax, and that's fine. If that's what you want to do, and the government's very happy to take your money. On the other hand, if you're willing to do things the government would like you to do with your money, like invest in, build housing, build commercial developments, build power plants, if you will. I mean, build companies that employ thousands of people. If you want to do those things and be an active partner with the government, then the government will give you a tax incentive to do that, because they recognize the risk that you're taking. And frankly, the government gets a lot out of it. I'm actually finishing up a book right now. It's going to be released soon, that talks about how much the government gets out of these incentives. The government actually does better than the taxpayer does. So this whole discussion about, oh, the rich don't pay taxes. Well, they don't, but that's the rich who use their money the way the government wants them to do. So rich people who spend all their money or just save it, they pay tons of taxes. Rich people who take their money and invest it the way the government wants it invested and are willing to risk it in things like housing, they don't pay as much tax. So this is not some nefarious thing that's going on with a bunch of lobbyists in Washington for the rich. This is actually something that is the government is not only complicit, but the government benefits from. So that's actually the first place to start, is to realize that. And then you can start looking at, okay, so where have the incentives been and where are they going? Well, particularly with 2017 tax law change, Matt, we know they went heavy towards real estate, right? We got bonus depreciation on real estate, even used real estate. We still have the like-kind exchanges. We have all sorts of tax benefits for real estate. In the new law, those benefits don't go away. In fact, they are added to. One of the big dollar incentives under the new bill is additional incentives for low-income housing. So they continue to move. They're not taking any of the tax benefits away from real estate. Okay, they're taking a lot of tax benefits away from small business. So this is the big shift. The shift is away from small business. Okay, so they're going after business and big business too. Big business, they're looking at increasing the tax rate from 21 to 26.5%. And that's not the only tax increase the big business is getting. They're getting their international taxes are going up too. So, excuse me. So there are, there's just a shift in incentives. Now, renewable energy getting huge tax benefits. Child tax credit. So this is a redistribution of wealth. Okay. So basically what they're doing from an economic standpoint is they're saying, look, rather than have long-term investment, which is where the money would go if, the high income people had the money, right? We're going to send it to low income, and we know they'll spend it right away. So the idea behind that is, if you want to just put a lot of money into the economy immediately, it's a little different. It's a little like, do I have a healthy diet and exercise, or do I get really good, cheap calories right now? I get a Big Mac or I eat a candy bar, right? So that's kind of the distinction they're making right now. And frankly, that's the way they're going. This new bill is looking at, well, we're going to, outside of the investment in energy, which is significant, the tax benefits for energy, a lot of the tax benefits go to the workers, and particularly but not just the low income. By the way, 90%, over 90% of the voting public will get tax credits under this new bill. So you're taking money from certainly from the super rich, but also from the successful business owner. And you're basically turning it over to the, you're taking the money from the top, pretty much the top 10%, and giving it to the bottom 90%.
Yeah. And I think one interesting thing, I know you kind of touched on it briefly there, was, your work on, that next book, and kind of, how you're thinking about advising people on saying, hey, you're a partner with the government. You need to understand their perspective on it. Do you have any kind of tips or strategies there on, especially framing, this new proposal, how the newbie or, the mom and pop real estate investor should be thinking about this, thinking about the government's perspective and strategies they can be using?
So the tax law is really not that complex. The details are very complex, and you need a tax advisor for the details. But the concepts are really pretty simple. What you have to do is find out, what does the government want you to do? Okay, where are those incentives? And start by reading my book, Tax-Free Wealth, and my podcast, WealthAbility Show. We go through those in very simple ways. Okay. With my new book, you will actually see 7 specific investments. So there will be 7 specific investments that the government is really promoting, and they promote them pretty hard. Interestingly enough, the one where the government gets the least bang for their buck, in fact, they get no bang for their buck, is retirement plans, 401ks and IRAs. They get absolutely zero from that. The government would actually be better off financially if we did not have retirement plans. The government does much better with things like energy and business and real estate. So it's really just a matter of understanding, where are those incentives. And in the new law, like I said, the incentives are in renewable energy and low-income housing. Those are the two big incentives are going to be renewable energy, including charging stations, by the way. That's included in renewable energy. Charging stations, solar, wind, all of those, as well as low-income housing. Got it.
Yeah. And I know you mentioned those 7 specific things. Can you maybe do a brief overview of, the most important ones, maybe?
Sure. Absolutely. Well, they're all important. It's really interesting. So really take your 4 asset classes and start there, right? Business, real estate, paper assets, not so much. Okay. Those are not, except for in the retirement plan, right? That's where the retirement plans come in. That's where life insurance comes in. So those are 2 paper assets that the government heavily favors: life insurance and retirement. Although under the new law, so here's a little kicker for you. Under the new law, you will be capped out at $10 million on your retirement plan. Okay. If you go over at $10 million, you're going to start distributing. There will be no more backdoor Roth IRAs. In other words, you can't heavily contribute to a regular pension plan and then convert it to a Roth unless your income's under a certain level. Which, by the way, I should just mention to you that the target income that thereafter is 400,000 individual, 500,000 married under this new bill. What that means is that next year, none of my clients will have income over 500,000 on their tax return, because that's the target. If you're under 500,000 filing a joint return, you will not get a tax increase. You'll not get a direct tax increase under this new bill. Okay, you will get a tax increase, but it will be through a lower stock market price, and some other costs that you will incur. But the direct tax will not be on anybody under $500,000 joint or $400,000 single. So that's really, and that's all the way through the bill. So know that is your target. If you're making more than that, you want to make sure that you're investing such that if you want your taxes to not go up, you want to invest in such a way that your taxable income, remember, in the US and most countries, we start with our income, but we get to subtract out deductions before we get to taxable income. And so the deductions are important. Well, the deductions include bonus depreciation. The deductions include bonus depreciation on solar energy. They include deductions, business deductions, anything you spend in your business. They include anything you spend on your farm. So all of these are deductions. So really, when you look at the investments that they're focused on, you're looking at things like business, real estate, agriculture, research and development, okay, is a big one. Technology development is a big one. And low-income housing is huge. Just know that it's going to get bigger, and renewable energy is going to get bigger. Energy is a big one. So commodities, things that we need every day, like energy and food, those things get special tax benefits under the tax law. And if you're investing in those areas, you're going to get those tax benefits to go along with it.
Yep. Just a quick reminder to everybody as well, feel free to jump in and say hello in the chat, say where you're calling in from. Feel free to ask questions. Again, I have plenty for you, Tom, but anybody else I want to make sure has the opportunity to jump in and, throw their questions in the chat too. But someone said, can I get a free copy of your book for being a captive audience? You've got a fantastic free podcast. Do you want to talk about that quickly?
Yeah. So the WealthAbility Show is for investors and entrepreneurs, and we have amazing guests. We had, and it'll probably come out this week, guests that I had on we recorded last week, that we're talking about this new provision that is being discussed in order. This is the, you can know a politician is lying because their mouth is open, right? That's what you can know. So they say, well, we're going to tax the rich. Here's the thing now, but what they want is they want to give back the state and local income tax deduction, right? Because people are leaving California and New York and New Jersey in droves to get out of those high tax states, because one of the things they want is well, come on back, we'll get you that state and local tax deduction. Well, Tax Foundation did numbers. I've done the numbers. If they reinstate the state and local tax deduction, rich people in those states will actually get a tax decrease. In the high tax states, you will get a tax decrease if they reinstate that state and local tax deduction, because that's how big that deduction is. I mean, if you think in California, it's 13.3%, right, on the top income. And if you get all of a sudden the deduction for 13.3% of your income, well, if you're in a 40% tax bracket, 13 times 40%, that's over a 5% reduction, but your taxing rate's only going to go up 2.5%. So that means that you're getting a net tax benefit by having this change in the tax law. So, these politicians, they speak out of both sides of their mouths all the time. We're going to tax the rich, but then we're going to give it back to them. But only if they live in states that vote for us. Okay, so that's pretty much what's going on there. Just know that's how politics work. I mean, this isn't new. It's the Republicans did the same thing, right? They took away the state and local tax deduction, saying, forget you guys have big tax burdens. We're gonna benefit our constituency that has low taxes, and that's basically what they did. So it goes both ways, but that's one of the things that they're doing in order to pay for that state and local deduction is they're talking about a requirement for banks to report all of your deposits in your bank account for the year, in every single bank account, and everything you took out of the bank, everything that came out of the bank, whether it's expenses or withdrawals or whatever. What the IRS is going to do with that, we have no idea, but they say it's going to raise $600 billion. So you can expect that they think that they're going to catch people. The banks are going nuts over this because, like the community banks, they can't possibly, handling this kind of reporting. And here's the thing. The argument is, well, the business owners, they don't get a 1099, but they do. You get a 1099 for your services. You get 1099, so that's already in there. But they want to add this reporting requirement. The banks are going crazy over it. And of course, it's not a small invasion of privacy, but this is just more, Big Brother type stuff, frankly. And they're looking at those. Now, in real estate, of course, your tenants probably aren't sending you a 1099. So now the banks are going to get reported on your rental income. You'll get that will be reported to the IRS, where it probably hasn't been reported prior to now.
Yeah. Yeah, I think that's kind of a good transition too. I know there'll be a fair number of people that watch this that are newbies. Maybe they're just getting into real estate investing, or have a small portfolio, or have wholesaled a few times, something like that. Can you maybe talk about just the broader benefits of real estate and how it applies to taxes? And then secondarily to that, I think Tony asked a really good question here that I'll throw up that said, hey, can you please explain the benefits of using a self-directed IRA to do real estate investing? So maybe, broader.
Okay. Well, let's talk about the big picture, and let's talk about, and Tony's not going to like my answer, frankly. I'm going to tell you right now, so stay tuned. The real benefits are the bonus depreciation, right? So let's say that you buy a $100,000 single family home in the Midwest somewhere, and you put $20,000 down. Well, your first year deduction is probably going to be up to $25,000 if you do a cost segregation. Well, so you put in 20, but because the bank put in 80, you're getting 25% of the total purchase price the very first year. That's a $25,000 deduction against other income, presumably. Okay. Now, if you do it right, now you have to have good tax advisors to get that the full benefit the first year. But that $25,000 could offset your wages. For example, it could offset your business income. It certainly will offset any real estate income for sure. So that's a huge benefit for investing in real estate. And that is the number one benefit, which, by the way, you don't get if you invest through an IRA. Just for example. Okay, but let's go to the rest of it. I don't think you can do wholesaling through an IRA. I think it's illegal. Okay. I know a lot of people do it, and I know a lot of people talk about it. Here's the rule. If you, and the new law makes this very clear, that you as the beneficial owner of the IRA, you are a prohibited person from dealing with that IRA. So in other words, if you render services, wholesaling would be rendering services to that IRA, that's a prohibited transaction. And there are all sorts of penalties, and your IRA, you blow your IRA, it all gets distributed, plus you got all sorts of penalties. It's a wholesaling in an IRA is a horrible idea. It's a horrible idea. It's a business. And and on top of which, it's probably taxable as a business. Okay. It's not investing. Wholesaling is not investing. Wholesaling is a business, right? You've got a product, you've got inventory, real estate, and you're wholesaling it. Okay. That's a service that you're providing. That's a business. That's not investing. Investing is buy, hold, for the long term. That's investing. So think about it this way. A business is something that you get paid for your efforts, and investing is something that you get paid for time. Okay, so you think about rent investing, you get paid for time, right? It's the time they're in the real estate. Or you get the capital gains, that's based on time, how long you held that. So that's investing. Business is different, and wholesaling is a business. Self-directed IRAs are extraordinarily dangerous, and I'll tell you, people don't normally say, well, gee, Tommy, that's awfully conservative. No, it's just the law. Why would you want to play with the law that way? I mean, there's ways to set up your wholesaling that you can have low tax. There's ways to invest to have low tax. You don't need to cheat. You don't need to do it through your IRA. Okay. Just a comment on the new law. The new law is going to prohibit, it'll prohibit you investing in a syndication through your IRA. So if you need to be an accredited investor, it will prohibit that in an IRA. We don't know what will happen with 401ks and pension plans, but we do know for IRAs, they're going to prohibit that. And I think that law is going to, I think that's going to pass. I think that's going to be included. I don't think there's enough people that are against it. So I would expect that one to get through into the final bill.
Mm-hmm. Yeah, I'd say we have a fair number of people that they will, that are watching this that are, they're wholesaling, but like Tom said, do it the right way, the above board way. Also thinking about buying and holding. And I think, Tom, you do a great job of kind of breaking down, the tax strategy or the tax advantages of buying and holding.
Let me explain something here, Matt, though. So some people say, well, what if I invest my IRA in long-term real estate? Well, you've just lost all the tax benefits from real estate. The tax benefits are the depreciation. You don't get depreciation if you invest through your IRA. you don't get capital gains. You don't get to do a 1031 because when you pull that money out, it's going to be taxed at your ordinary income rates. So any CPA worth their salt that knows anything about real estate will never suggest you invest in real estate through an IRA, period. It's just, are there exceptions to that rule? Of course. There are always exceptions that prove the rule. But as a general rule, it's just a bad idea. Just from a tax standpoint, it's a terrible idea.
Do you, I know obviously you guys are phenomenal at, you know, what you do on the WealthAbility side and helping people with their taxes and how real estate plays into that. Outside of you guys, do you have any advice on how to find in your local market that CPA that knows what they're talking about when it comes to real estate and, you know, can help you there?
Here's the problem. Why would you want to find somebody in your local market? Why would you not rather find somebody who's a specialist? I mean, people are spent the last year and a half moving out of California and New York into the middle of the country and saying, look, I don't need to be where my job is. Well, why would you need to be where your CPA is? That makes no sense. Now, we do have 40 CPA firms around the country. Okay. We do everything virtually. We have not had paper for 15 years. Okay. So the pandemic did not even put a dent in us because we don't have people coming into our office. You know, I mean, seriously, how many of you really want to sit down and spend time face-to-face with your CPA? Not the most exciting person in the world. Okay. That's my profession.
I enjoyed coffee. Our coffee was great.
Okay.
But hey.
You know, it's just, boy, it's like, you know what? I've got this actuary. Let's sit down and spend a lot of time face-to-face with my actuary. No, you want the results and you're going to have a phone call and you're going to have meetings and so forth. But what you want is somebody who really understands your business and understands the system. So I was talking to Matt and I were talking, we were talking about earlier saying, you know what, I've really been focused lately on watching the patterns in the tax law. So if you look at the patterns in the tax law, for example, there are only 6 ways to reduce your taxes. Okay. It's what entity are you using to hold your investments, deductions. Okay. What type of income do you have? We call that conversion because we're converting from a high tax income to a lower tax, like ordinary income to capital gains, for example. All right. We look at tax brackets because we have these graduated tax rates. We look at eliminating taxes like through tax credits, like the solar energy credit, like a low-income housing credit, and non-taxable income like life insurance. And then if all else fails, we look at postponing the taxes to a later year. We call that deferrals. That's IRAs, okay, and 401ks and pension plans, et cetera. We only do that as a last resort, though, because that's a temporary tax benefit, and all the others are permanent tax benefits. So my book, the subtitle is how to build massive tax-free wealth by permanently lowering your taxes, not temporarily through IRAs and 401ks and so forth. So I'm not a big fan. I'm just, you got your money tied up in the IRA, the 401k, what you can do, you're tied up, you can't do. I truly believe you cannot do wholesaling. I guess it's possible you could structure it such, but then it would be still taxable in your IRA. So because it's a business. So I don't know why anybody would do that unless they've been, told to do that by a promoter, right? Frankly, that's a promoter telling you to do that. Always find out. Always follow the money. Why are they telling me what they're telling me? Okay, and you can follow money with me. With us, WealthAbility. Our job is education. We want you to get educated. We think that an educated client is a better client. Okay, and if you want help finding a CPA, call us at WealthAbility. Go to wealthability.com and call us. Here's the thing: we've vetted our CPAs, so we already done all that work for you. And we vetted the CPAs. We trained the CPAs. I talk to them on a constant basis. We're constantly training them. So we're doing all that vetting for you. So you don't have to go out and try to do this on your own. And if you want to do that, chapter 23 of my book, Tax-Free Wealth, actually walks you through how to find a good tax advisor. So that would be the instruction guide for it. If you want to learn how to find a CPA, do that. If you just want one handed to you, then call us.
There you go. Yeah. And didn't mean to like tee up too much and make it too much of a commercial or anything, but definitely, you guys are fantastic.
It is what it is.
Great podcast, great YouTube content. So highly recommend watching all that stuff. And then somebody on Facebook was commenting in real time and said, we want you as our CPA. What are next steps? And then you said, give them a call. And they said, boom, we're going to give you a call. So there you go. But
we're literally, Matt, we're out to revolutionize the profession. We truly believe that this profession needs a massive overhaul. And rather than expect somebody else to do it, we just decided to take it on. So it's a pretty big task. It's probably the rest of my life, frankly, to do it. But it's worth doing it because I think entrepreneurs and investors deserve better CPAs. And I think CPAs deserve to be doing better work than, tax returns and financial statements. So that's why we do it.
Yeah, love it. And Tom, I know you touched on a little bit around and teach people to do this the right way, but can you maybe talk through, I know you have a 5-step framework specifically on real estate investors and eliminating income tax from the real estate deals. Could you spend some good time kind of walking through that playbook, breaking that down for us? I think that's something that people will really really be curious about as well.
Yeah. So this is all video, right? Can I use my flip chart?
Yeah, go for it. That'd be great.
Okay. All right. So this is from Robert Kiyosaki's second book, Cash Flow Quadrant. You can see this, right?
You might have to shift it over just a little bit closer to you to get on camera. There you go. Keep going. There you go. Perfect.
How's that?
Yeah.
Does that work?
Looking good.
Okay. All right. All right. So basically, fundamentally, there's 4 ways to make money, right? If you make money as an employee, you pay about 40%. As a self-employed or small business, you pay about 60%. As a big business, you pay about 20%. And as a professional investor, you pay 0. So this is our target right here, is that professional investor, okay? So how do you do that? Well, the first thing to do is realize that you're going to become a professional and that there are certain things that you would typically do over here that you're never going to do over here. Okay, so for example, one is over here, you're going to do everything yourself, right? You're going to do it yourself. You're going to do your own tax returns. You're going to do your own wholesaling. You're going to manage your own properties. You're going to do it all over here. Where over here, these people always have a team. Right? So you're always going to have a team. Team is such a big part of successful investing. Why would you do something yourself and you hire somebody else to do it? I mean, I don't understand that, but I'm lazy. So I'd prefer not to do things myself if I can hire somebody else who knows how to do it better than I do. So I don't find my own real estate deals. I don't do my own financing. I don't manage my own properties. I don't do any of that. Okay. That's what my team's for. Okay. Second of all, over here, what you find is that I call it one-off. Over here, people tend to invest. So typically amateur investors tend to look at every deal in a vacuum. Is this a good deal? Should I do this deal? Will this make sense? And so they get very scattered. So they're always looking for the best return. Okay. Over here, these people don't do that. Okay. They're looking for a system. If you look at the top real estate investors, they all are very focused on a particular system for investing. All right. And they do the same kind of investing all the time. So they might, if they're single family homes, they're doing 3-2s or 4-2s in a particular type of neighborhood, in a particular type of market.
Yeah,
okay.
Specific buy box. Yeah. Mm-hmm.
You do. You have to know exactly what you're investing in, and your team has to know exactly what you're investing in, right? There's a system for doing it. Well, guess what? Taxes are the same thing. There is a system for doing this, right? The system is you start with, okay, how am I going to own my real estate? How am I going to own it? Am I going to own it individually? Am I going to own it as a partnership? Am I going to own it in a corporation? Well, I'm going to tell you right now, here's where you're not going to own it. You're not going to own it in your IRA, and you're not going to own it in a corporation. Two bad ideas. All right. Where are you going to own it? Probably in a limited liability company or limited partnership. If you want to own it on your own, still own it through a limited liability company. Okay. So that entity setup that you do, that is step number one. Get the entity right. If you're wholesaling, again, not an investment. That's a business. Business uses corporations. Investors use partnerships. Businesses use corporations. Investors use partnerships. General rule. And a limited liability company can be either one, but for real estate, it's going to be a partnership. Actually, a limited liability company for wholesaling, it's going to be a corporation. Okay. And that's same for fix and flips. Okay. If you're not wholesaling, if you're just fixing, flipping, that's also a business. That's not investing. That's effort, not time. So keep that effort versus time in mind, and it will serve you really, really well. Okay. Because you'll know, okay, am I going to get the big tax benefits from it? I am if it's investing. Here's what I want to do. Let me kind of walk you through, and we do this in one of our education videos. But let's say that you've got your house and you're flipping or you're wholesaling. Okay, that's ordinary income. That's actually 60% tax rate. Okay, now let's say that instead we put it into an entity. We put it into a corporation. Okay, say an S corporation. Now we've gone from 60% to 40%. So just by changing it into a corporation, we're flipping, right? We're still flipping. We're flipping and wholesaling. We put it in S corporation. Now we're in the 40%. Now let's say instead what we do is we decide to hold it. Okay. So now we take it and we're going, you know what? We're going to put in renters. Now all of a sudden, that income, the income from it is 0%. And on top of that, when we sell it, it's either long-term capital gain, or even better, we do a Section 1031 exchange, which by the way is not going away under this new tax law. And we exchange it. So we never have to pay tax. We can, if we need to pull money out, we borrow, because borrowing is not subject to tax. Okay. So all we're doing here is we're going from 60% to 40% to long-term capital gain at 20%, but ultimately to 0%, simply by the way we own it and what we do with it. Okay, so it's really simple steps to do, but you have to consider, am I in a business? And if I'm in a business, I want to be here. And then what I want to do is I also want to own this kind of real estate so that the losses from here can offset the income from here. Okay, yep. So another way to look at this real quick is, just go back here. It may be that I'm earning money somewhere over here. What I want to do is I want to take my money from, say, here. I want to move it over here. Mm-hmm. And then I want to add debt plus debt. And that's how I'm going to get rid of my taxes. Donald Trump's famous for this. The New York Times exposed how smart Donald Trump was with his taxes. Okay, they exposed how smart Donald Trump was with taxes. He earned $400 million over here on The Apprentice. He took it, invested in real estate, and got back a $70 million refund. So that's exactly what the New York Times accused Donald Trump of, is actually getting a refund for investing in real estate, which is exactly what the government wanted him to do. So That's something that anybody can do. It doesn't have to be $400 million. It can be $400,000. It can be $40,000. Okay. As long as you put it into real estate, as long as you put it into an investment, but it has to be an investment again, time, not effort. As long as you put it into an investment, you can get all those depreciation deductions, all those low income housing credits, all those solar credits. Those are investments. If you're flipping it, you're not going to get that. Just know that that's a business. That's over here. So you still need your long-term investments for those losses to offset your short-term income. Is that helpful?
Yeah, getting those out a little interactive visual for us. But I know you talked about part of that of going from the ES left half to going to the right side. Like you said, was hiring. It's having a team. It's having other people to help you there. Do you have any tips there on assembling a team on the real estate side? And
I do.
How to do that?
Yeah. Well, first of all, you have to know what you're doing before you can tell a team member what you're doing. Right. So the biggest challenge that investors have is they don't know what they're doing. They haven't created their system. See, you've got to create your system. Once you create your system, you can tell your team, okay, here's the system we operate under. Could you follow that system? I do the same thing with my CPAs. So I say, look, here's the system we use for reducing taxes. It works every time. Here's the system we use. You follow the system, it's going to work. You don't follow the system, it's not going to work. Okay, so follow the system. Every once in a while, we'll get a complaint, and it'll be, we actually had somebody who went directly to our CPA. Our CPAs, to use our system, they have to, be part of us, right? But they went directly to a CPA, and the CPA didn't use our system. So they didn't reduce their taxes. They came back and complained to us. We go, well, you didn't come through us. You went directly to the CPA. So you didn't get the system. But what you want is you want to develop your own systems, and then you want your team to have systems, and you want to marry all that together so that you get the best experience every single time. So I'll give you an example. I've got a good friend who's a big multifamily syndicator. What people like about his syndications, his projects, they're multifamily, is that he goes into the same market, same type of a market, okay? He does the same renovations. His projects all look alike. If you see one of his projects, go, that's one of this guy's projects, okay? That's how it ought to be for even if you're doing single family homes. Somebody ought to go, oh, you know what? That's one of Matt's houses because this is what it looks like. So basically part of what you're doing is, remember right here, B also stands for brand. And ultimately what you'd like to do is create a brand. And you can create a brand if you only have 10 houses. Your tenants will talk. You can create a brand with your tenants. You can have them set up a Facebook group to talk to each other. Now, if you're afraid of your tenants talking to each other, you probably ought to reconsider what you're doing, right? You'd like your tenants to be able to talk to each other and be happy talking to each other and say, wow, man, isn't Matt great the way he did this? And, he's always coming and change our air filters, and he's always coming in, he's always checking in with us. And he wants to make sure that, we're good with our everything during COVID and that we're healthy, all that kind of stuff. And whatever that is. I have another client, I have another developer, and they go in and they completely change they take a multifamily and they make it so livable. That's what they want. It's a very different model than this other guy I was talking about. Their model is they want the tenants to just love living there. That's what they want. Okay, it's not about numbers to them. It's about, can we get the tenants to love living there? And they've won award after award after award from the cities, okay, that they go into, because the cities love them because they're upgrading everything. They're upgrading the whole neighborhood. They're upgrading the whole experience. And they're taking, say, a B- or a C+ apartment building, turn it into a B+ or an A- apartment building. And the whole experience is different. So, remember, real estate's a business. Okay. Yes, it's taxed as an investment if it's long-term hold, but in fact, it's a business. And so you have to treat, any good business owner knows that it's all about systems, and all of your team members need to have their systems as well.
Yep. And
that's why you guys have a system.
Yeah, I was going to say we preach that as well, 100%. So definitely on board with that. One last reminder to everybody, we only have a few minutes left today. Feel free to get in some last minute questions if you have any for Tom while he's here. We really appreciate your time today, Tom, as well. But do you think you talk about systems and establishing that, and the DIY investor just looks at a deal and says, this is a good deal or not, whereas the business, the scaling member, who I think a lot of people listening to this want to become, they find that system, build that, and then hire others to execute on it. Do you have any advice on those newbies trying to find that niche, trying to find that, that initial system?
I do. We actually work with our clients that way. We actually teach people how to do that. That's part of, actually, if you, those of you, person said they were going to call us, we will actually force you to do this. Okay, we have our system and it works every time, so we use our system. We'll actually force you to focus. So our number one job is to help you focus, because here's what you want to do. You want to decide, what's my market? What type of house do I want? What type of tenant do I want? What type of mortgage? What type of loan do I want? What type of management do I want? You want to decide all those. So we call those our set of criteria, because here's a simple way to remember this. An amateur investor makes a new decision every single investment. A professional investor makes a single decision and then applies that over and over and over again. So you make the decision once. Are you going to tweak it? Yeah, but you're going to make that decision once. You're going to say, here's the type of tenant I want. Here's the location I want. Here's the, do I want a 3-2, a 4-2? Do I want a 2-2? Do I want condos? Do I want to be in vacation housing, which is a whole different business? Okay. What is it I want to do? And let's get really specific and really narrow. The old saying is, a niche will make me rich. Okay. That is true in real estate more than any other business I've ever been in. And the mistake people make is they constantly flip flop and go, well, where's the return? And it doesn't work that way. There are great returns in every single strategy, and there are bad returns in every single strategy. It just depends on how focused you are. So it really comes down to getting that focus. And then once you have the focus, once you know exactly what, setting up the system's easy. I mean, after you get focused on what you're doing, setting up the system is a piece of cake. It really is. I mean, it's just not that hard, because now you know exactly what you're going to invest in, how you're going to invest, and you can just tell your team, and your team can come up with everything.
Yeah. Do you think on that team side as well, and I'll give people a few more minutes to get any final questions in here, but on that team side as well, once you have found that niche, can you kind of talk through, your advice on team members to be bringing on quickly, and, how to kind of, how to think through that as well?
Quick, I'll actually show you who should be on your team right away. Okay.
There we go.
Okay. So up here, this is you. Right. You're the lead of your team. Don't ever forget that. People forget that they're in charge of their team. Very first person you have to have. Bookkeeper. If you are your bookkeeper, or your spouse is your bookkeeper, or your aunt or uncle is your bookkeeper, you need to fire your bookkeeper and get a real professional bookkeeper. Okay. Seriously, folks, bookkeeping is cheap. Find somebody who can do it better than you can do it. Why would you spend your time? Okay. Then you have the next two people. You have your accountant, which is not your bookkeeper. Maybe in the same company, but it's not the same person. Okay. And you have your attorney. Then you have two other people down here. Your banker and your insurance agent. Okay. I would say those are your 6 key members of any team, and any real estate team, any business team. This person is, the bookkeeper's job is accuracy. The accountant's job is analysis. Don't expect your bookkeeper to analyze things, and don't hire your accountant to do accuracy. You should have a bookkeeper for that. Accountants are way more expensive, and so you should have that. And then make sure that these people are talking together. These people are talking together, because you want to make sure there's communication all the way through here. That's a big problem that I see, is that a lot of times the attorney and the accountant aren't talking to each other, and so they're just pointing fingers at each other.
Yeah. Yeah. And I think it's like you said, interesting point to remember that you're always the lead, and it can be easy to forget that. So appreciate you pointing that out. But
it's your money.
I know, do what?
It's your money.
Yeah, exactly. Well, this has been fantastic, Tom. I know we have to wrap up here. Again, really appreciate your time. Do you have any other places that people can get in touch with you, or best place to follow up with you? It sounds like YouTube, Facebook, or YouTube podcast.
We have a YouTube channel. We have the WealthAbility Show, WealthAbility.com. If you want to get in touch with us, just go to WealthAbility.com, schedule a call. We're happy to do that. So anyway, we can help you. Really, we've got some great. We've got a whole learning management system, LMS, and we have a whole series of courses that teach this, because we want you to be educated. We think that the more educated you are, the more successful you'll be, and we know that the more successful you are, the more you're going to need us. So we're, it's very selfish on our part. We would like you to be educated. We really want to help you understand better, because we want you to be more successful. It's in our best interest.
I love that's why you guys, you put out great educational content. That's the same thing with us too. Like, we're only going to be successful if you are successful using our tool. Right. So, we're always trying to help people out in that way as well on our end. But again, Tom, thanks for coming on. Appreciate it.
Absolutely. Anytime. Thanks, everyone.
All right. Yeah, thanks. And this is Matt Cannon with DealMachine, and to everyone watching, happy deal finding.